Hello everyone, and welcome back to the channel. In today's video, we're going to take a closer look at a case study of how an individual with $20,000 in credit card debt can pay it off by leveraging velocity banking. We'll take a deep look into the velocity banking strategy, as well as compare it to just allocating free cash flow to the credit card. Be sure to stay to the end of the video to see what the true savings of interest will be in this case study. For those new to the channel, welcome to Concepts Made Simple, where we aim to simplify everyday financial and self-improvement topics. If you're looking for more content around velocity banking and finances, be sure to subscribe to the channel down below. In today's case study, we're going to be taking a closer look at John, who currently has $20,000 in credit card debt that carries an interest rate of 18%. Before getting into how John can use velocity banking, we need to better understand his current situation. John currently has a monthly income of $8,000 and has $7,000 in monthly expenses. This leaves John with a monthly cash flow of $1,000. Out of John's expenses, $5,500 are eligible to be paid through his credit card. This is important to note, as John will essentially be using his credit card as a checking account and needs to know which expenses can be paid onto his credit card. The next step is for John to leave $1,500 in his account to cover his expenses that cannot be paid on his credit card, and allocate the remainder of his income onto his credit card, which is equal to $6,500. Now, let's take a look at where this leaves John. He has now reduced his credit card balance down to $13,500 and has $5,500 left in expenses that need to be paid from his credit card. Once John has paid all of his expenses onto his credit card, his remaining balance will now be equal to $19,000. Of course, John will still need to pay interest on this balance. However, since all of his expenses are not coming out all at once, this helps to lower his average daily balance. This number is calculated by adding up the balance on John's card each day of the month and then dividing by the days in the month. So if John is able to skew more expenses towards the end of the month, this will help with lowering his average daily balance. For simplicity's sake, we will base John's average daily balance on the assumption that all of his expenses will come out evenly across the month. This leaves John with an average daily balance of $16,250. John's 18% owed in interest will then be based on this amount, meaning his interest for the first month will be $243.75, leaving his card balance at $19,243.75. Now, if John had decided to not use velocity banking and just put his $1,000 of monthly cash flow onto his credit card, his average daily balance would be equal to $19,000. And by virtue of his average daily balance being higher, he would owe a higher interest amount at $285. This means that by using velocity banking this month, John was able to save $41.25 in interest. Although at first glance this can seem like an insignificant amount, it's important to remember that although John brings in $8,000 a month, he has $7,000 in expenses, meaning his monthly cash flow is only $1,000. The extra $41.25 in saved interest has increased his monthly cash flow by approximately 4.1%. Before looking at how long it will take John to pay off the remainder of his credit card using velocity banking, I first want to call out a benefit of this strategy that is often overlooked, which is around credit card rewards. Since John has now paid all of his expenses onto his credit card, he's adding an additional $5,500 in purchases onto his card, which are typically eligible for rewards such as cashback or reward points. In John's case, he earns approximately 1% back, meaning he has an additional $55 in monthly cash flow, which he can then put towards paying down the balance on his credit card. The next step for John is to now repeat the process of paying all of his expenses onto his credit card and then allocating his saved interest and cash back to pay down the balance until his credit card is paid off in full. If John is able to stick to the process and stay consistent with his velocity banking strategy, it will take him approximately 22 and a half months to fully pay off the balance on his credit card. Throughout this payment period, John will pay a total of around $2,441 in interest. Now, let's compare this to our other scenario, which is if John just allocated his $1,000 of monthly cash flow onto his credit card. In this case, it would take John approximately 24 and a half months to pay down his credit card and his total interest paid would be around $3,534. Meaning John was able to pay off his debt of $20,000 approximately 2 months faster and save around $1,093 in interest payments. John was able to achieve this by making a simple change to his finances, which was essentially using his credit card as a checking account to pay for his expenses rather than using his bank account. However, the results in this case study are dependent on John having perfect discipline. Although using his credit card to pay his expenses can seem like a minor change, it does open the door to some pretty major risk. And the number one risk being that as John puts the majority of his monthly income onto his credit card, he's opening up additional space on his card. This is important because for many individuals, their struggle with finances and debt does not come from the fact that they can't understand the math, but rather they have a difficult time coming up with a plan and sticking to it. Before committing to any strategy like velocity banking, it's important to look at both the numbers and carefully evaluate your own ability to have self-discipline when it comes to your finances. Thank you for watching today's video, and if you found the video to be helpful, it would be greatly appreciated if you could leave a like and consider subscribing to the channel for more content around velocity banking and finance. Thank you for watching, and we'll see you next time.